After studying this module, you shall be able to know the UNIDO approach of project appraisal, learn the stages involved in such analysis, identify tradable and non-tradable goods, know the criteria for selecting shadow prices. To begin with, the SCBA empowers the government, especially in the developing countries, to take up or sanction mega projects which commit positive social impact on its society, thereby furthering the development in an economy in a significant way. Among various techniques to analyze and evaluate the social impact on such projects, United Nations Industrial Development Organization, that is UNIDO, developed a set of procedures or guidelines for project appraisal, popularly known by the name UNIDO Analysis. First, we will discuss about UNIDO Analysis. The UNIDO approach provides a comprehensive framework for SCBA in developing countries. In this regard, there are following two publications of UNIDO. First is the Guidelines for Project Evaluation of 1973 and second is the Guide to Practical Project Appraisal of 1978. The United Nations Industrial Development Organization, popularly known as UNIDO, has developed a comprehensive approach to the social cost benefit analysis. The approach is called UNIDO approach after the name of the organization. The approach has evolved through a series of symposia conducted by the UNIDO during the 60s. The final methodology of the project has been published by the UNIDO in the earlier part of the 70s. Now, we will discuss about the stages involved in UNIDO analysis. In order to measure the social benefit of the project, the approach provides 5 stages. Each of the 5 stages is based on modification of integrated standard analytical tables which along with the graphical analysis help the analyst to do a complete economic evaluation of a project and its quantifiable social impacts. It is quite obvious that a single project can be analyzed from different angles. It may be financial, economic, social, political, etc. The stages designed in UNIDO analysis have been designed in such a manner so that all the possible different angles may be considered for the project analysis. Since all the angles are required to be analyzed, all the 5 stages in UNIDO are relevant. The very first criteria for any project is financial profitability, which includes the technical and financial analysis. Now, this commercial aspect of profitability would be sufficient enough if the prices of the resources reflect the relative scarcity of the goods. This is possible in case of perfect markets only. But if the market is imperfect, the economic benefit analysis of stage 2 is required. Analysis is required for the impact of project on savings and investments, especially for the projects that generate benefits to the groups who save very little out of the additional income. That is, where there is a gap between the actual and the needed savings for investment. One of the steps of this approach is also related with the impact on income distribution, as the government gives the priority to increasing the income of the poor. It means the project should have its impact in such a manner that it should generate more than average benefits to either the very rich or to very poor. The approach also makes adjustment for the impact of project on social values. But it is obvious that this is required in special circumstances only, where the project produces, I repeat, where the project produces or uses a good whose social value is different from the economic value. The approach can be studied in the following stages, each of which leads towards a measure of the social benefit of the project.
Next, we will discuss about fundamentals of shadow pricing. The second step of the approach requires the measurement of net benefits, in terms of shadow prices. That is why the basic concepts and issues relating to shadow prices should be discussed so as to calculate the same for the specific resources under UNIDO approach. The major issues are the following: the concept of tradability, the sources of shadow prices, the treatment of taxes, the choice of nume'raire, and the use of adjustment factor. The concept of tradability. Tradability is related with the fact whether the goods can be imported or exported. When any country produces in excess of its requirement, the surplus is exported. On the other hand, if there is unsatisfied demand, the shortfall is mete out through import of that material. A good is said to be tradable if the good can be imported instead of domestic production and can be exported instead of domestic consumption. For example, if we consider the case of land, then it is not a tradable item. The economic opportunity cost or its real value to the country in terms of pure efficiency of such a good is the international prices. There are three main categories on the basis of tradability, that is, tradable non-tradable goods. Traded non-traded goods are tradable goods, traded goods, non-tradable goods, non-traded goods. Tradable goods. These are the goods which have the potential for being imported or exported. It is not necessary that these are actually imported or exported. Mere presence of capability is sufficient for being called as tradable. It implies that movement of these goods is possible in the absence of trade barriers such as tariffs and quantitative restrictions. Traded goods. These are those tradable goods which are actually traded, that is, imported or exported. It is very clear that some goods have the potential of being traded, but due to government restrictions in the form of trade policies, the goods are actually not traded. Non-tradable goods. These are those goods whose real domestic cost of production, together with its international transport cost, is too high to permit export and too low to make import attractive. Non-traded goods. These are those tradable goods which are actually not traded because of the trade policies of the country. The sources of shadow prices. There may be two cases depending upon the conditions of the market: perfect market conditions, imperfect market conditions. Perfect market conditions. In the case of perfect market, the source of shadow prices would be its market price. When resources are not traded internationally, in a perfect market, the price that the consumers are willing to pay for one more unit would be exactly equals to the producer's cost of supplying it. That is, the marginal value would be equals to the marginal cost. When resources are traded internationally, in such cases, when the resources are traded internationally, the market price would also equal the relevant border price. But because of the existence of market imperfections like tariffs, quotas, and monopolies, distortions are created in demand and supply, and there is a little chance that the market will reflect the true economic value and cost of inputs and outputs. Imperfect market conditions. In the case of imperfect market conditions, there are three recommended sources of shadow prices depending on the project's impact on the national economy. A project through its use and production of resources for any given input or output may affect the supply available to the rest of the economy, level of its production in the rest of the economy, level of its imports or exports. In terms of production of an output, the project may increase total consumption in the economy, decrease production in other parts of the economy, decrease imports or increase exports. The corollary impacts of a project's consumption of inputs may be to decrease consumption in the rest of the economy, to increase production within the economy, to increase imports or decrease exports. A project may have all the three of these impacts simultaneously, and they in turn may affect both inputs and outputs. The treatment of taxes. The treatment of taxes is very important in the calculation of shadow prices or efficiency prices. Inclusion of taxes. Exclusion of taxes. Inclusion of taxes. When a project takes non-traded inputs that are in fixed supply away from other producers or adds non-traded consumer goods, taxes should be included as part of the indication of the consumer willingness to pay the marginal economic value. Exclusion of taxes. Taxes should be ignored for fully traded goods, and taxes should be excluded if the project increases the production by other domestic producers. The choice of nume'raire. The determination of the nume'raire is one of the foremost steps in the shadow pricing. We always require a unit of measurement for expression of values computed. The term nume'raire is the determination of unit of account in which the values of inputs and outputs are to be expressed. The problem of unit of measurement becomes tedious when various types of quantities are to be used on aggregative basis. A nume'raire is the unit of account in which unlike quantities are expressed so that they can be added up. Its complexity depends on the differences among the items to be summed that are worthy of consideration. In order to establish a nume'raire, there are many factors to be taken into consideration, including the following: inflation, present value, shadow prices, savings and consumption, distribution, etc. Specifications required for nume'raire. There are many specifications like the value and unit of currency, the relative price system, actual recipient on the basis of standard of living. When we want to use nume'raire for the purpose of project analysis, considering the economic and social aspects, the above stated specifications are required to be embedded. In this regard, following specifications are relevant. A nume'raire, if it is to serve the purpose of economic and social project analysis, must include specifications with respect to the following: the full specification of the UNIDO nume'raire in terms of these criteria is the net present consumption benefits in the hands of people at the base level of consumption in the private sector in terms of constant price domestic accounting rupees. This stage produces an estimate of the project's financial profit when all inputs and outputs are measured at market prices. A wide variety of appraisals have been suggested to judge the financial profitability of the project. These can be classified into two broad categories as follows: discounting criteria, Non-discounting criteria. Discounting criteria: net present value, benefit cost ratio, internal rate of return. Non-discounting criteria: urgency, payback period, accounting rate of return. These appraisal techniques have already been covered in Module 19. This stage produces an estimate of the net present value of the project measured at efficiency price instead of market prices. In fact, the market prices reflect the shadow prices or efficiency prices only in perfect market condition. Selective shadow pricing of specific resources, non-tradable inputs and outputs. Selective shadow pricing. All the shadow prices should be derived from a comprehensive mathematical model of the economy. But this is theoretical view. In fact, there are two criteria to be taken into account. To ascertain which resources figure most prominently in the benefits and cost of the project at market prices, and to find out the resources whose market prices are significantly different from the shadow prices. These criteria should be noted that both these criteria must be applied simultaneously. There are 4 items for shadow pricing, namely main outputs, importable material inputs, major non-imported material inputs, and unskilled labor. Shadow pricing of specific resources. The guidelines of UNIDO talk about tradable and non-tradable inputs and outputs. The shadow price of a good, if it is fully tradable, is the international price. A non-traded good must be valued at its marginal economic value. Non-tradable inputs and outputs. The guidelines of UNIDO talk about the tradable and non-tradable inputs and outputs. The shadow is a natural non-tradable one if the domestic cost of production is above the CIF prices, that is, the cost of import, or if its FOB export prices is less than its domestic cost of production. Externalities. These may be considered as a special class of non-traded goods that may be either positive or negative. These goods do not have a market price and in some cases may by law or custom be given away. The society has not designed a mechanism for charging beneficiaries or for compensatory payment by producers. An economic value can be imputed to some resources such as housing for workers on the basis of comparable facilities for which a price is charged. Labor inputs. Labor is usually thought as a service rather than a good, but the principles of shadow pricing used for goods apply here. The analyst must consider the project's impact on the rest of the economy when it hires labor. The shadow wage rate can be determined in a manner directly analogous to that used for other inputs. The impact may fall on other employers, on the production of labor, or on its imports. It should also be noted that the additional consumption of foreign exchange out of the additional earnings because of the project should be included as one of the economic cost of employing labor. Capital inputs. The capital cost of a project can be seen from two different perspectives for shadow pricing. The shadow pricing of capital presents two problems. A. How to measure the value of the physical asset per se. B. How to measure the rental value or the opportunity cost of capital, the benefits foregone by freezing investable resources as assets in project, or instead of using them somewhere else. Pricing of the assets component is exactly the same as for any other resource. Foreign exchange. As the UNIDO method uses domestic currency as the numeraire, the project's foreign exchange impact must be identified so that the project's net present economic value may be adjusted by an appropriate premium, assuming that foreign exchange is more valuable than indicated by the exchange rate. In principle, all inputs and outputs are either tradable, that can be valued directly in terms of foreign exchange, or non-tradable, whose input can be disaggregated in terms of tradable, non-tradable, and labor. If the non-tradable identified in the first round of disaggregation are further disaggregated in a similar manner, and so on. Theoretically, any non-tradable can be valued in terms of its foreign exchange, domestic labor, and capital content. The shadow price of a foreign exchange is equal to submission I goes from 1 to n Fi into Qi into Pi, where Fi stands for the fraction of foreign exchange at the margin spent on importing commodity I, Qi represents the quantity of commodity I that can be bought with the unit of foreign exchange, and Pi stands for the domestic market clearing price of commodity. The best known approach to determine the cost of producing foreign exchange is the domestic resource cost method proposed by Michael Bruno. Next, we will discuss about the impact on savings and investments. The scarcity of capital is one of the major problems of developing countries. That is why the impact of a project on savings and also the value of savings become important in these countries. Therefore, the stage 3 is designed to determine the amount of income gained or lost because of the project by different income groups. The net impact of these gains and losses on savings and give the marginal propensity to save each of these groups is also evaluated. Impact on savings. The effect on savings of this income redistribution depends on the percentage of additional income each of these groups save, its marginal propensity to save, and the rate of return that can be earned on the savings. Saving impact of a project is equals to submission change in yi into MPSI, where change in yi represents the change in income of group I as a result of the project, and MPSI is the marginal propensity to save of group I. Value of savings. It is the additional consumption stream produced when that rupee of saving is invested at the margin. The rate of return that can be earned on each additional unit of savings is called the marginal productivity of capital. In other words, it is the income that can be generated from each additional unit of investment invested at the margin. If the marginal productivity of capital is S and the reinvestment rate on additional income arising from reinvestment is I, the case flow can be represented as follows. Having derived the cash flows, our next job is to calculate their present value, which represents the value of the savings in today's terms. But for calculating the present value, we need a discount rate. Which rate should we use? The rate to be used is called the social discount rate. How is it determined? It is generally subjective and depends on the value on savings by the person carrying out the appraisal. Higher the value placed on generation of savings, lower is the discount rate, and vice versa. The value of each unit of savings is equal to the present value of consumption it provides in future. That is, present value of 1 unit of savings we started with in the table at a discount rate of D is equals to S into 1 minus I is equals to S into 1 minus I divided by 1 plus D plus S into 1 minus I into 1 minus Si divided by 1 plus D whole square plus S into 1 minus I into 1 minus Si whole square divided by 1 plus D whole cube root plus and so on till S into 1 plus I into 1 plus Si to the power n minus 1 divided by 1 plus d to the power n into n. The above expression may be simplified to equals to S into 1 minus I divided by 1 plus d the whole divided by 1 minus Si divided by 1 plus d. This could be also written as S into 1 minus I divided by 1 plus d into 1 plus d divided by 1 plus d minus 1 plus Si. This could also be further reduced to S into 1 plus I divided by d minus Si. Now, we will discuss about the adjustment for the project's impact on income distribution. Stage 4. This stage is important to the extent of priority that the government gives to increase the income of the poor. There is a need to analyze the impact, whether the benefits are expected to accrue to rich or poor. When the government has not been able to accomplish the distribution of income directly and efficiently through macroeconomic policy measures such as taxes and subsidies, then high priority is given on this aspect while selecting project. The net present values are required to be adjusted depending upon the objective and the degree to which they can help accomplish it. Income distribution impact. Since the project's distribution impact on income flow has been measured in preparation for stage 3, it is relatively easy to calculate. For the purpose, the target groups for income distribution are identified separately and the net gain or loss of income by each group is calculated. Estimation of distribution weights. The UNIDO guidelines suggest that weights can be determined through an iterative process between the analyst at the bottom and the planners at the top. The analyst has to determine the weights these planners implicitly assign when they accept some and reject others, using the preference revealed by the planners for projects with different net present values and distribution impacts. Distribution adjustment factors. The adjustment of the income of each group is done separately to reflect the differential social values. The outcome of adjustment is then added to the net benefit, taking income distribution into account. The income flow value are then multiplied by the adjustment factors and the product is added to or subtracted from the net present values which have been adjusted for savings impact to other social net present values that reflect the income distribution impact of the project. The adjustment factor will naturally be negative for income flows to the rich and positive to the poor. This stage will probably be needed only in unusual instances where the product produces or uses a good whose social value is different from economic value. Merit goods, demerit goods, procedure for taking into account the difference. Merit goods. If the social value of the good is more than its efficiency value, the good may be called a merit good, and an upward adjustment should be made. For instance, a country may want foreign exchange simply to increase its ability to withhold its exports for strategic political reasons. Demerit goods. If the social value of a good is less than its efficiency value, then that good may be called as demerit good, and a downward adjustment should be made. For example, a country may include tobacco or alcohol and luxury consumption items in this category. Procedure for taking into account the difference. The procedure for taking into account the difference between the economic and social values of a good is basically same as in the previous stages. The estimation of social value, the calculation of adjustment factor by subtracting unity from the ratio of its social value to its economic value. The efficiency price is then multiplied by the adjustment factor to obtain the adjustment. The final adjustment is then added algebraically to the net present value of stage 4.
Let us now summarize what we have learnt in this module. The United Nations Industrial Development Organization has developed the approach called as UNIDO. The UNIDO approach provides a comprehensive framework for SCBA in developing countries. The approach can be studied in the following stages. The 5 stages of analysis combined with the technical and managerial analysis that must be part of the financial analysis complete the conventional project appraisal.